Welcome to the Michael Yardney podcast. In today's monthly Big Picture episode with Pete Wargent, we're going to be exploring the nightmare ahead because of our capital city housing shortage. We'll be talking about how the budget will affect our property markets, and Pete and I will explain a bit about how build to rent works, because as a property investor, you must know about it. We'll also discuss the retreat from the regions, plus lots more. So whether you're a seasoned investor or just starting out in your property journey, you won't want to miss this episode. So join us for the next half an hour or so as we explore the big picture factors that potentially are going to influence the future direction of our housing markets.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
In these regular Big Picture podcasts with Pete Wargent, we discuss the macroeconomic factors affecting our economy and our property markets. And boy, has a lot happened since our last show a month ago. The RBA hiked interest rates again in May. We've had a federal budget, and there's more evidence that we've passed the market bottom. And that's why I'm delighted to have Pete Wargent join us again as one of Australia's most respected financial analysts and commentators. Pete brings his invaluable experience to help us navigate this ever-changing landscape of the Australian economy and property markets. Hi, Pete.
Hi, Michael. It's only a week since I last saw you up at the Gold Coast. So,
yes.
We just had a wealth retreat up there. Fantastic occasion, as always. And looking forward to another chat today.
Well, yes, we enjoy getting together with a small group of high net worth clients. And again, we're planning to do it at the same time, end of April next year. But boy, has a lot happened even in the last week since we caught up with each other. There's lots of things I'd like to talk about, but maybe we should start with one of the questions many investors are asking. What do you think about rate hikes? It's old news now that the Reserve Bank raised rates again at the beginning of May. And many commentators believe that's the last rate hike. In fact, all the banks are now forecasting interest rate falls earlier next year, maybe even late this year. But on the other hand, Pete, there still seem to be some commentators suggesting we're going to have a few more rate rises.
Yeah, there's definitely a demand for media commentary on what's going to happen next week, what's going to happen next month, and it's almost required of the major banks and their chief economists to put out all of these forecasts. I think the important thing as an investor, and if you think back to the great hedge fund investor Stanley Druckenmiller, he always used to say, don't invest for how the world is today, invest for how you think the world is going to be 24 months from now. So there may or may not be another rate hike. But I think the important thing is if you're looking further out, even 18 months from now, market pricing is for a cash rate target of 3%, which is quite a long way below where we are today at 3.85. So whether or not we get another hike, it's not such a big factor in the grand scheme of things. I think most investors and most people in the market are now less fearful. They realise rates aren't going to keep going up and up and up as they feared in October and November. US inflation has fallen from 9% last year to 4.9%. Producer price inflation in the States is back to 2%. I think if you look in Australia, we're tracking a little bit behind some other parts of the world because we stayed locked down for longer. But here we've got fuel prices now, 9% lower than a year ago. I think if you look 3 or 4 months out, the narrative will start to shift. The fear of high inflation will start to go away, and we'll be talking about other risks by then, things like a slowdown in the economy. So we're pretty close to the top, I think.
Well, that's the interest rate cycle, but a lot of commentators believe that we've now reached or passed the property market downturn. Now, as we've often said, there is not one property market, so the property market bottom isn't a particular day or week or month. But over the last couple of months, all the research houses have shown regular, gentle increases. We haven't got another property boom ahead, but Andrew Wilson's My Housing Market has been showing national quarterly house price markets rebounding for the third consecutive quarter. CoreLogic's National Home Value Index showed 2 months of rising prices. Now, again, particularly led by Sydney and Melbourne, PropTrack, which is owned by REA, reported that after declining for most of last year, home prices have increased again in April, marking the fourth consecutive quarter of their measure of rising prices. So if somebody asked you, where are we in the cycle, what would you say?
Upturn phase. I think the peak of the fear was around about October 2022. And then since that time, I think people started to realize that we were getting close to the top of the interest rate cycle. It's an interesting point there you make about the difference between Sydney and Melbourne and some of the other markets. Over the past week since I last saw you, I've been driving down the east coast of Australia, and it's actually noticeable now, just a little bit less hectic, some of those lifestyle regions. And that's because people are starting to make a bit of a population reversal back to the larger capital cities. So places like Byron Bay, the north coast of New South Wales, but also the Blue Mountains, Gold Coast, and SQM researchers reported the same, Mornington Peninsula, Sunshine Coast. People are just starting to leave some of those lifestyle regions, just getting sucked back gradually into the big city markets. And it's starting to show up in things like rental vacancy rates, which are rising in some of the regional markets. So I think there's a bit of a two-speed thing happening, but this time it's the capital cities that are leading the recovery.
Well, getting back to the regional markets before we discuss the capital cities, yes, rentals have become easier to find. Vacancies are rising in the lifestyle regions now. Rents have started to drop a little bit there compared to in the capital cities. But getting back to the capital cities, even the capital cities, Pete, there isn't one Sydney or Melbourne property market. And when you look at the different tiers, the upper tier of the Sydney and Melbourne markets, which were the most expensive, 25% of properties, they fell the most, and they've now started to pick up, while during the downturn, the lower price properties actually didn't fall as much, but they're now still continuing to fall. So there's still going to be price falls in some locations.
It does make sense for this stage of the cycle. So what we're seeing with very low unemployment, there's actually not many people selling their property. The new listings are down about 20% or so from a year ago. But if you look at the total number of listings on the market, they're down nearly, a third lower than normal, not far off. So there's a real shortage of quality stock. So you get desirable homes coming onto the market. We see this most weekends now. You'll see a lot of competition at some auctions. There was a couple this week. There was one down your way in Melbourne that went 2 million over the price reserve. So I think it is actually some of those A-grade properties, desirable family homes that are really outperforming now, because people are just keen to get on with life and start buying. But there just isn't that much stock. And I think looking further ahead, Sydney and Melbourne in particular, and to some degree Brisbane, we're not really building the medium density housing that we used to a decade ago. So there's a big shortage of property building up, sort of brewing up in the market. So that's actually underpinning prices as well.
Very much so. And I'd like to actually get your thoughts on that in a moment. But just to maybe conclude this train of thought, this last property downturn actually has been shorter, but it actually was deeper than previous property cycles. But it started in February 2022 in Sydney, maybe in March in Melbourne, and it was only in July that last year that the Brisbane market started to go down. But I think it's that shortage, that supply-demand imbalance that's actually holding prices higher. And I don't think we're going to see a significant increase until rates start to fall a bit, which is probably going to happen early next year. But that doesn't mean prices aren't creeping up. If you look at the figures from the various research houses, they're going up 0.5%, 1% a month. But if you annualise that, then values of well-located properties could well be 6, 7, 8% higher at the end of this year, Pete.
It only ever takes two people bidding for a property, and suddenly the whole dynamic, the whole situation completely changes. If there's only one potential buyer, then they've always got the upper hand and prices get negotiated lower. But we're often seeing now for the more desirable properties, multiple bidders. And you're right, so that is actually pushing prices back up a little bit, especially in Sydney. As you mentioned, prices up nearly 4% over the past 3 months. So I don't always like to annualise those figures because a lot can change, but it does show the direction is back up. Yeah, the stock shortage is just growing and growing at the moment.
Well, that's a real challenge ahead. And at Wealth Retreat, we spoke about the nightmare ahead, because while Australians are grappling with the worst housing shortage in history, I believe, if you dug deep into the budget papers, the federal government's official net overseas migration forecasts increased aggressively. What they suggested last year was we'd have 235,000 net overseas migrants, but now they're predicting something like 400,000 in the 22-23 year. That'll slow down a bit to 315,000 in the next financial year and then moderate. But what sort of hidden there, they didn't talk about a lot, was that they've actually permanently locked in this net overseas migration numbers higher than their previous budgets, higher than the intergenerational report we spoke about a couple of years ago, higher than their population statement. And plus that, we're going to be welcoming more students, temporary visa holders, meaning our population could increase. This is just even up to 1.5 million in the next 5 years, and possibly even in the next 3 years if you take into account those temporary visa holders. Pete, to put that in perspective, into context, it's the equivalent of adding 5 Canberras worth of people to Australia's population in the next 5 years, but we haven't got the necessary housing or infrastructure. I guess it's equivalent of adding another Perth to Australia's population in the next 3, 4, 5 years.
It's a massive change from where things were even a year ago. If you look at last year's budget, as you mentioned, we weren't expecting to see this kind of a rebound in population growth. So if you're not familiar with the numbers, net overseas migration for this financial year, so that's the year to June 2023, they're predicting about 400,000 people. But there's also the natural growth of the population on top of that. So because generally we have more births than deaths in Australia, so you can stick another 150,000 on top of that for the total population growth. Next financial year, another 315,000 for net overseas migration. And then even just going out across the forecast time horizon, the numbers are higher than they were, 260,000, 260,000 and so on. So you're right. If you actually look at the total number of people in the country, over 3 years, it will probably go up by about 1.4 million, looking at about maybe 2 million over 5 years. It's a huge amount. And what we do know about new arrivals into the country, including people like myself, is that new arrivals tend to go to Sydney first and foremost and Melbourne because those are the most familiar cities to them. And it's also where most of the job opportunities have been historically. So that has a massive impact, particularly on the rental market because most new arrivals are renters initially. So big pressure. And the demand for housing construction is now at a record high just at a time when all of our builders and developers are under severe pressure. Many of them are going bust now. You're right, could potentially be a bit of a nightmare shortage.
Yes, there is, and there's no simple end in sight. Now, the budget came up with a couple of ideas, but it's fiddling around the edges. Pete, what did you think of Treasurer Jim Chalmers' budgets that he recently handed down?
I think overall it was pretty sensible, pretty solid. There was nothing too unexpected. I think that's the most important thing for markets, for investors. They don't like surprises or nasty surprises. There was a bit of talk about whether being a relatively big spending budget compared to what we've seen in years past, there might be some inflationary impact. It will be a budget because of the cost of living relief. It will actually mechanically reduce inflation over the next year. I think some economists were a bit concerned that if you reduce the cost of living in some areas, then spending just picks up somewhere else, and it sort of potentially even has an inflationary impact. I think, to be fair, though, if you look at what financial markets did and their reaction, there was no move. I think at the moment, consumers are generally tightening their belts, and therefore markets do expect inflation just to keep falling. So overall, it was pretty solid. As you mentioned, there was a couple of measures there relating to housing supply, and there was a couple of welcome measures as well, things like more support for veterans, victims of domestic violence, and so on. So I think overall, it was pretty solid. And quite big spending, actually. So quite a lot of government money flowing around the economy over the next few years.
Well, one of the discussion points has been this new build-to-rent initiative where the government is encouraging institutional developers, big corporations, and often foreign ones, to build large complexes, to hold them over the long term, at least 10 years, to build a minimum of 50 apartments in a complex, and then to rent them out for a minimum of 3 years. And this is something that's worked overseas. It's worked in the UK. It's taken some time to take off there. It's the way it's happening in America as well. But if we see current experience, Mirvac's only completed 2 buildings in the build-to-rent sector, and they've come on the market at 25% more rent than the going market rent because they're offering more amenities. So while it may add to the rental pool, it's not going to help the affordability issue, is it?
It's kind of a separate market, really, from the private landlord and the private home buyer market. So actually on my travels this week, I came through Homebush, which is one of the areas you'd expect to see build to rent taking off. The way these things usually work is that nothing happens for a couple of years, and then probably in about 3 years' time, we'll suddenly see a glut of these new build to rent units hit the market all at the same time. I think the important thing to remember is that it's not altruistic building here. These are big corporations and investment funds who are building to make a profit. So the rents won't be cheap. The rents will actually be, as you mentioned, probably 25% above the normal market rate. But it does change the balance somewhat of the rental supply. So if you look over 10 years, we might expect to see maybe 150,000 build to rent units. Probably about 60% or so of those would be in Melbourne, which is a bit more amenable to that sort of thing. Sydney is quite difficult the way these projects work because of land prices, and the supply is not always easy. I guess the thing is, if you're delivering, say, for the sake of argument, 15 or 20,000 build to rent units in a year, in the grand scheme of a big market with 11 million dwellings, it's not that much. So it does change the balance of the rental supply a little bit over a decade, but it doesn't really move the needle in terms of total housing supply.
It's got to be remembered, of course, that the reason that institutions may be interested in this is because the government's going to give them some tax relief and it's going to increase depreciation allowance. And that's coming out of the government's coffers, and that means it's coming out of your and my pocket, Pete.
Yes, it's a bit of an ideological thing. As a general rule anyway, the left of centre parties or centre-left parties, they like the idea of build to rent. You generally find that the more conservative parties, or Australia, the Liberal coalition, they tend to like individual aspiration a little bit more and less keen on build to rent. But yes, it's the incentives are being put in place there to make it more attractive, and not just for investors like Mirvac, for example. In Australia, there will also be some funds from overseas raising capital at the present time to build sort of new build-to-rent apartment projects. I think what we've seen overseas is that converting old buildings into build-to-rent just doesn't really work that well. So generally, these will be new build apartments, higher density, and the tenants will be allowed to sign up for minimum 3-year leases, which gives them security of tenure, which is one of the things that is sometimes missing in the private landlord market. So it does have its place, but I don't think overall it's going to be a major factor in the market.
Pete, while build-to-rent is definitely going to supply good accommodation, I believe a quicker, much faster way is to encourage mum and dad investors. Remember, the majority of property on the rental market are owned by ordinary Australian mums and dads. And at the moment, they're nervous. They're worried by rising interest rates, by rising holding costs, extra land tax, more compliance, more government interference, maybe more, a little bit favouring for tenants. But it wouldn't take much in the way of tax incentives or loosening finance restrictions, maybe APRA lowering its finance buffers or not charging as much for investor loans to swing sentiment around. That's not going to help the supply of the total accommodation situation, but it may stop many of the investors getting out of the property market.
You're right. The biggest factor in supply is usually rising prices. I think if people see that prices are flat or falling, then there's very little incentive to buy new property, especially at a time when people are a bit twitchy about builders and developers going into liquidation or becoming insolvent. With the way that construction costs have gone over the past 3 years, for median density and higher density dwellings, you guys would know better than me, but some people have been saying up to 50% more expensive, yes, in total. Yeah. So you really need to see higher prices for new developments before the supply will start to rise again. I think for the individual investor, we've still got in place this 300 basis points lending assessment buffer, which means that people can borrow a lot less than they could 18 months ago. So that isn't helping. And it's a bit of a handbrake on investor activity at a time when we actually need more landlords in the market. So it looks like APRA is going to hold on the 300 basis points buffer for the rest of 2023. But at some point, you would think that would reset back to 250 or maybe 200.
Now, I'm going to say something that some may find controversial, but I like to see foreign investors come back into the market as well. They're only able to buy new or off-the-plan residential properties, and they underpinned many of the apartment towers that were built during the last property boom. Now, there was talk about foreign investors pushing up the house prices, making it less affordable for Australians, but they couldn't buy established properties. There was also talk about foreign investors keeping their properties vacant for a while and having all those towers with big vacancies. But what they did do was actually make enough pre-sales to allow the towers to be built. That's not happening at the moment.
Yes, we saw the introduction of stamp duty surcharges for non-resident investors, and that was really one of the big drivers of the last construction boom, particularly Chinese mainland investors looking to get capital out of China into another country as a way of diversification. We've effectively taxed those investors out of the market now. Not as many Aussies will buy new apartments, especially some of those smaller units that we saw in the last construction boom, where you get the 60 square metre, 2-bedroom apartments. Most Aussies don't buy them, except potentially in their super funds. So I think for as long as we have those surcharges in place, there's going to be a real handicap on rental supply and new housing supply in the higher density sector. There's plenty of detached housing being built around the country, but we're just not seeing the units and apartments go up this time around.
And we need that if we want to get accommodation built in bulk. Now, by the way, we're not recommending people invest in them, but I've got no issue with other people underpinning the construction of those. Now, Peter, over the last couple of weeks, there's also been the discussion about a per capita recession. There's been talk about recessions in various parts of the world and rising interest rates causing one in Australia. The International Monetary Fund suggests we're going to have a feeble and uneven global output over the rest of the year, but most people feel Australia is going to avoid an all-out recession over the next year. In other words, where there's 2 quarters of negative GDP. But for some people, it's already starting to feel like one as the cost of living's increasing, interest rate hikes are causing people to just close their wallets. So while we may avoid a full-blown recession, I guess, is that now going to be hidden just by the fact that there's more of us?
Yeah, so this is a bit of a technical definition. So normally when economists talk about a recession, and this is up for debate, by the way, it's just one of the definitions, but
There's a number of definitions, aren't there?
yeah, that's right. I mean, traditionally it was said if you had 2 quarters where the economy contracted in a row, then that would be what's known as a recession. So, for example, if the economy went backwards in the June quarter and then it went backwards again in the September quarter, that would be known as a recession. Now, I suppose you could make the case, well, what if the economy absolutely boomed in the early parts of the year and then slowed down a bit? It could still be bigger over the course of a year, despite going backwards over 2 quarters. So some people would say, well, it's more about what happens to the unemployment rate, and if that rises sharply, it's a recession. I think what we are likely to see, if you looked at the budget papers, obviously headline growth in the economy has been pretty strong. It was around 4%. And in nominal terms, because we've had high inflation, it's been in double-digit territory. So that's obviously going to slow right down. So real GDP, which strips out the inflation effectively, expected to be around 1.5% over the 2024 financial year. Now, we already said we've got record high population growth. So what we're talking about when they say per capita recession, the economy itself will grow by 1.5%, but that's really just because we've got more people. A lot of a slowdown in spending per capita or per consumer is what we're expecting to see. The unemployment rate, well, at the moment, it's about 3.5%. Over the next 2 years, they're probably expecting that to creep back up to about 4.5%, which is much more, I think, sustainable in the economy. We don't usually get unemployment going much below 4% like that.
Well, when we have a recession, and I remember way back when we had a bad one, the media had a field day, and that actually was almost a self-perpetuating thing where people just were worried about their jobs and stopped spending. But we actually had a couple of quarters of negative GDP. Was it a couple of years ago? And nobody really felt it.
We did during the COVID lockdowns. It was fairly inevitable if you keep people at home. then obviously the economy is going to contract. But as you mentioned, Australia hasn't really had a really deep recession since the early 1990s. We even pretty much dodged the global financial crisis recession. In Australia, we only didn't get the 2 quarters of contraction. So really, we've had 3 decades of phenomenal success. And this is just as somebody who travels around the world a lot, it really is just phenomenal, the amount of wealth that Australia has created over the past 30 years. We've had big resources construction boom, and that kind of segued or parlayed into the resources export boom. We had big construction boom of apartments, and then that sort of rolled into a demographic boom from China and now India. And Australia's, yes, we've had a couple of periods where things slowed down a bit, but really the big picture, as the podcast is named, is that Australia's phenomenal performance over several decades now. Yeah, we might get a bit of a slowdown this year, but there's nothing really in the forecast to get too worried about there.
Well, I think the next 10 years, the next decade is going to be as good as the last decade. And you and I heard Simon Kirstenmacher at Wealth Retreat talk about the demographic reasons behind that. I think that's one of the things I know you spend time researching as we do at Metropole, because when you look at how many of us there are, where we want to live, at what stage of our lives we are, how we want to be accommodated, are we going to upsize, downsize, have families, the future looks pretty bright, doesn't it?
I often say Australia is a lucky country, originally mentioned in the book by Donald Horne. But in many respects, Australia is very lucky, resources rich, situated away from some of the other pressures that we're seeing and conflicts in other parts of the world, massively popular with international students, as we're seeing now. Tourism is big in Australia. The resources, the depth of reserves that we've got in this country is quite incredible. So, yeah, there's always challenges. And if you read too many of the headlines, you can get a bit sort of bogged down in the day-to-day. But actually, the big picture is Australia has been very, very fortunate.
Now, that would be a great end for this podcast because we're finishing on a high. But there's one more thing I'd like to discuss, and that's a concept from the Greens suggesting we should cap rentals. And they even for a while talked about capping interest rate increases. I think the thought behind it was that at 1.1%, our national vacancy rate is crippling the rental market. Tenants are having to pay more rent. They're trying to, I guess in their mind, do the right thing by tenants. But to me, they just don't have an understanding of how housing markets work, Pete.
I think it would be fair to say that some of the Green Party policies on the economy, they're not very consistently applied or proposed, I think. And yes, price capping generally doesn't work in economics. We've seen various attempts, not just in housing, but also in things like resources and energy. Generally speaking, it doesn't work. I think the thing to remember is that the bulk of the housing market rental supply, as we've touched on, is provided by mum and dad investors and private landlords, but they don't have to invest in rental housing. They could just as easily put more money into superannuation, could put money into the Australian stock market. These days, they could invest internationally. They could put even money now into bonds and fixed interest. Now interest rates have gone up. If you make the disincentives for landlords too high, and we've seen plenty of this over the past decade with changes to lending criteria, changes to tenancy rules. In some other countries like New Zealand and the United Kingdom, there have been restrictions on interest deduction at tax time, and that hasn't helped the rental market there. So at some point, if you make it too much of a disincentive for landlords, it's just going to reduce the rental supply. So short term, it might keep a cap on rents, but over 3 or 5 years, it's just going to create a spike in rent. So it's not a brilliant proposal from the Greens overall.
Not at all. And if landlords don't have as much money to be able to cover their costs, they're not going to be able to improve their properties. They're going to hold back doing repairs. I think rent capping just doesn't make any sense at all. But if we go back to what we said just a moment ago, we've gotten through the worst of the property market downturn. We've gotten through the worst of inflation, and it's probably coming under control, but slowly. Interest rates, we may have one more rise, maybe even 2, but unlikely, and then they're going to start going down. So the best is yet to come, Pete.
I think if we take the idea of investing for where you think the world will be, in 24 months' time, well, inflation will no longer be in the news. Inflation will be back under control. It might even be falling too much by then. We know we've got a massive population boom in Australia. So there's going to be plenty of opportunities in property. But as you always say, just got to make sure you focus on the key landlocked locations where the demand's going to be growing, but there'll be plenty of opportunity ahead.
Fantastic. Well, thank you very much, Pete. Great to catch up with you once a month on these monthly Big Picture podcasts. I bet there's going to be lots of news to discuss in 4 weeks' time.
Sure will be. Thanks, Michael.
In a moment, I'm going to share my mindset message with you. But before I do, I'd like to ask you a little favour. If you got benefit from my chat with Pete Wargent and you don't already subscribe to this podcast, on whatever podcast player you're listening to, subscribe to it now so you get our regular show twice a week, and once a month there'll be this Big Picture podcast with Pete Wargent. I was surprised to find out that there's lots of people listening to this regularly, but who actually don't subscribe. Now, again, in a moment I'll share my mindset message with you, but I think the message you should have been getting from my chat with Pete was that this nascent housing recovery, particularly in Sydney and Melbourne, has got legs. Now, don't expect any significant price growth for the rest of 2023, but 2024 is likely to see our property markets increasing as interest rates drop. Now, when that's going to happen, no one's sure. Is there going to be another 1 or 2 interest rate rises or none? No one really knows yet. It'll depend upon so many factors, but there's no doubt that the property markets are looking for a floor. They've found a floor in some of the areas of, well, there's not one Sydney or Melbourne market, as we've already said, so you've got to be selective. But this is the right time to plan. So while I can't forecast exactly what's happening to the markets, what I can forecast for sure is what's going to happen to people who get involved in property investment. And why can I say that? Because the statistics haven't changed over the years, despite the highs and the lows and all the information out there. I know that a lot of people who get into property investment won't get the financial freedom they hope for, and many will end up selling up within the first 5 years. And of those who stay in the market, less than 8% end up with more than 2 properties. 92% never get past their first or second property. Now, you've heard me say that before. So why do some investors do better than others? They make the right decisions. And in general, they make the right decisions because they get the right advice. So if you'd like to get the strategies and the frameworks that I've fine-tuned over 5 decades and that my clients at Metropole have been helped with for over 20 years, go to metropole.com.au. And don't be surprised if we don't start talking about property. We're going to talk about you, where you are, what you want to achieve, what your risk profile is, what you're hoping to do along the journey, and then we'll help put a strategic plan together for you. And then, if you allow us, we'll help you implement that strategic property plan. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
I'd like to spend a couple of minutes speaking to you about the top 5 financial mistakes I see many people making. Maybe you're making some of these too. Because you see, becoming financially free is about your habits. It's not about getting lucky at the casino one night or a spectacular financial investment that happened to go your way or just buying at the beginning of a property boom and making money. It's about making good decisions day in, day out, and continuing to make those decisions over a long period of time until they become a habit. Once you commit to becoming financially free and wealthy, you see it as a lifelong way of behaving and thinking rather than something you just managed to pull off. This means following a few rules on what we allow ourselves to think and what we allow ourselves to dwell upon. Now, these can differ from person to person, depending upon what your strengths are, what your weaknesses are, but each of us should be guided by a few ideas on how we stay on track. Now, on this list, there probably should be things you do every day, like doing exercise, like learning something new, but there should also be things on the list that you don't do. So what could these be? Well, the ones I want to talk to you about today are ones to do with mindset. There are a handful of mindsets that people adopt that take up a lot of their time and energy and keep them from achieving their dreams. It holds them back because it stops people from getting wealthy. So if you can avoid adopting any of the following 5 mindsets I'm just about to share with you, they're common, by the way, too. You're already going to be ahead of the game. So the first one I want you to avoid is relying on a wage to get you wealthy. If you're like most people, you were taught by your parents to get a good education, get a good job, buy a house, pay it off, get a good salary. Now, don't get me wrong. A wage, a salary, it's important. You need cash flow. It provides the roof over your head. It gives you food on the table. So I'm not dismissing that, but you won't get ahead. You won't truly get ahead by working for somebody else. Now, I've often said that unless your money is making money for you while you're asleep, unless your investments are your businesses, you're never going to become wealthy. So you look at it in all areas too. The tech innovators, they worked for themselves. Now, it doesn't necessarily mean you've got to become an entrepreneur. Of course, you can still work for somebody while building a property investment business on the side. That's what a lot of Australians do. And you keep doing it until you can afford to toss in the 9 to 5. One thing's for certain, you need to drop the wage mindset and think like a business person, think like an entrepreneur. The second mindset you have to give up is thinking investing is too hard. Look, nothing in life comes easy, and you don't need to have worked in the financial property industry for 40 years to make good investments. What you need to do is get good advisors. You need to get a good team around you, and you can stand on their shoulders and you can go much further. You need to work hard. You've got to be resilient. You've got to be focused. But don't be fooled when people tell you that it's just too hard to invest. That's simply a cop-out. It's what others are telling themselves because they haven't got the courage to do it. You see, everything that's easy today was once hard. In fact, I remember the first investment book I bought many years ago, it would have been close to 40 years ago, was called The Courage to Be Rich. I didn't understand it. I knew I wanted it. I couldn't understand why people needed courage. So, mindset number two, you've got to avoid is thinking investing is too hard. Mindset number 3 to avoid is thinking that it's money that's causing your problems. Now, that's a big one for many people. They've had some setbacks. They walk away from investing altogether and they decide, look, all this money stuff, it's not for me. This investing stuff, it's not for me. What they don't understand, that money is for them. It's for everybody. And it's just what money represents to them that's the problem. Their own failure, things that haven't actually worked. But failure is a good thing, and money shouldn't be feared, shouldn't intimidate you. It's merely a means to an end, which is having a financially free life to choose to do what you want to do. And there's nothing wrong with chasing that. Now, you've heard me speak about it often before. True wealth isn't just about how many properties you've got or how much money you've got, but there's no doubt that having money helps get rid of a lot of your troubles. I'd much rather drive up to my problems in a Mercedes than in a Hyundai. Having said that, any problem that money can solve isn't really a problem anyway, is it? Okay, mindset number 3 you've got to get rid of. Thinking you don't deserve it. Now, this is something I see so often. People will never tell it to you outright. They won't say that they don't think they deserve to make money. But they'll show you they think this in many other ways. They're going to be self-sabotaging by blowing their money, by not committing to saving, by not chasing their dreams. They don't prioritize wealth because they think, deep down, they think it's never going to happen to them. They think like a poor person who's always going to remain poor rather than the person who's on their way to achieving wealth. Half the battle in becoming rich is giving yourself permission to be wealthy. Mindset number 5 that you have to get rid of is being afraid of making a mistake. Now, this is a big one for many people. Mistakes aren't bad things. Never. And yet we fear them. We fear making them. It's debilitating for many people. They're so afraid of messing up that they'd rather not even try. How sad is that? After all, this isn't a dress rehearsal and we've only got one chance in life to do what we really want to do. And it's just the way it is. Mistakes are a part of life. And the more you aim for, the more mistakes you're going to make. But the only true failure in life, I guess, is never letting yourself make a mistake. So don't compare your success or failure to anyone else's. Don't compare your chapter 1 to somebody else's chapter 12. Can you see how damaging that sort of mindset could be? Yet these mindsets I'm just discussing with you, the 5 mindsets I just shared with you, they're very common. So ask yourself, have you ever fallen into one of the above mindsets? I bet it's held you back. But the good news is there's always time to change them. Money doesn't discriminate, it doesn't care who owns it, so why not have your share? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?